Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. So this is Shane Chu. I will be the moderator for this session that is titled Understanding Cash Flow Management, the heartbeat of every business. So do you agree that cash is king? Okay, if yes, maybe you type Y in the comment box so we know. You see, cash flow is the bloodline of every business, and it's very important for us to get a very healthy operation cash flow so that we can grow the business, because a business can only grow as far as the cash flow allows. So today we are going to study deeply into cash flow management. So before we begin, as usual, disclaimer. So whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation to buy or sell any companies in this webinar. Whatever case study that we present in this webinar is only for educational purpose. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks, okay? So allow me to briefly introduce our speaker today, and he is none other than David Paul. Now, David is the founder of Spiral Thinker Groups in Berhad. An engineer by training, David began his career as an engineer in the telco industry for 10 years before turning to his passion in value investing. So David is now a full-time investor and dedicates his time and resources to nurture the youth in financial literacy. He is often invited to speak in brokers' webinars, seminars, as well as other Bursa endorsed events, and his professional comments and opinions on value investing are often featured in business publications like Focus Malaysia. So David also provides consultation services in value investing and advanced portfolio strategies for high net worth individuals. So David, it's an honor to have you here in the webinar today.
Hi, good evening, Shane. Thanks for having me again. It's nice to be back. Can you hear me properly?
All right, so let me hand over the session to you.
All right. Hope you guys can hear me loud and clear. All right. Well, once again, thanks a lot to Shane and LifeChamp as well as Bursa Malaysia for organizing all these educational webinars for everyone to learn, in this pandemic era. So if you are not new to LifeChamp, I'm sure that perhaps you guys would have seen or heard some of my webinars before, and I've been most of the time I talk about technology, businesses and stocks, as well as portfolio management. But tonight I would like to go back to the bit more basics, right? Back to how to analyze financial statements, but not just any financial statements. In fact, I just want to look at the most important financial statements of all, which is the cash flow statements. And that's why we term it as every business's heartbeat. All right. Now, it is very important, like what Shane has mentioned, actually, not just for business. In fact, on an individual level, knowing how to manage your cash flow is of absolute importance as well. Hopefully, through my sharing tonight, I can impart to you some sort of insights of how good companies manage their cash flows and how we can learn from them, as well as how not so good companies botch on their cash flow management and how we can avoid mistakes like theirs. All right. So as usual, our sessions, I usually speak to a few topics. So tonight, I'm going to start with the importance of cash flows and a quick introduction. Then I'm going to move on to talk about the 3 cash flow statements at a very high level angle. Then I'm going to dive into the working capital management, which is something not many people talk about. In fact, even during analyst briefing and fund managers briefing with public listed companies, I noticed that not a lot of people talk about working capital management. And tonight, I'm going to share with you guys why this is absolutely important. Okay. And last but not least, I'm going to end with a couple of case studies, very interesting ones. So make sure that you stay until the end. Yeah. Now I know that to some of you, we have slightly more than 300 participants tonight. Okay. It's a very far cry from the other technology related sessions. Yeah, Shane. But I'll try to make it as interesting as possible. All right. In fact, although this is a dry topic, all right, but I'll try to make it as interesting as possible. Okay, without much further ado, let me try to do this first. All right. Okay, let's start with the importance of cash flow. Okay, now just to recap, I think sometime back in April, when I started off with the first topic under the Islamic Capital Malaysia Market series, I talk about sustainable investing, right? And here I presented for the first time, I presented our model of looking how we look at companies. And if you remember, I stress a lot on quality compared to quantitative analysis. Now, but this topic, we're going to look at the quantitative aspect, which is actually the value. Now, under the value aspect, we've got the aspects of measuring the performance of a business, how strong it is in terms of balance sheet. So the performance, we measure it through P&L, profit and loss account, the strength through balance sheet. And last but not least is actually the cash flow statement, is where we look at how efficient is the management of this business. Yeah. Okay. And of course, as I mentioned before, although tonight is really about cash flow management of a business, right? In fact, you can learn a lot from how these great companies manage their cash flow and how we can emulate that in our daily lives. But of course, this is a very interesting game. I have it. I have one set on my own as well. It's a great way to spend your time with your family, with your kids, right? As well as to impart to them the knowledge of how to manage your own cash flow. It's a very fun game. Yeah. But don't hear it from me. Hear it from successful people like Mr. Tony Fernandez here. Now, although yes, AirAsia is going through a very rough patch. In fact, I think it's the most challenging time in the history of AirAsia, right? But notwithstanding the pandemic, which has brought AirAsia business down, right? But this is a great business, and the way the founders as well as the board of directors manage business is of absolute, I really have high respect for them. Now, we met at Spiral Thinker along with our members as well, along as our students. We met Tan Sri Tony Fernandez at the Red Q KII back in 2019, in April, exactly about 11 months before the pandemic hit. Yeah. So I mean, at that time, who would ever known, right? Who would ever guessed, right? There'll be a tiny little virus that will actually rock the whole, wreck the whole world, isn't it? Yeah. But one of the key takeaways from that day, right, at Red Q, actually, Tony Fernandez mentioned this, right? And I'm going to quote him here, verbatim. Yeah. He said that I am a cash person. He said, I'm not in this business for the P&L. I'm in a business for cash flow. And likely so, if you study the AirAsia's cash flow statements, right, of the P&L before the pandemic, you notice that AirAsia, this business is a cash cow. Before the pandemic hit, I remember they are doing they are booking a cash flow from operations, meaning the cash which is generated from the business operations. I think they are doing more than 2 billion ringgit a year. Now, imagine if you are a business owner whereby your business bring in cash. Now, I'm talking about real cash, not just, accounting profit. It's real cash coming in net of 2 billion ringgit. You can do a lot of things with this so much money, right? You can invest, you can expand your business, so on and so forth. And that is why tonight I want to talk about the importance of cash flow, right? So let's go straight towards the 3 important cash flow statements. Now, as you know, if you are already investor, right, or if you're just started investing, I'm sure you've heard of these 3 financial statements. I think the most popular one is the profit and loss, or what we call P&L. I think these days they call it a income statement. All right, and then we've got the balance sheet, statement of financial position or something like that, as well as the cash flow. Now, if you are privy or you read a lot of these analyst reports or news articles, you will notice that they focus a lot on P&L and balance sheet, and not a lot of people focus on cash flow statement. All right, now, P&L, of course, everybody know about sales, everybody know about net profit. Balance sheet, everybody know about how much debt a company carries, how much assets they have, so on and so forth. But I can tell you a lot of people, or even a lot of analysts or even investors, they do not really focus on cash flow. Now, why is cash flow so important? In our opinion, right, all 3 statements are important, but they each of them play a different role, show a different angle, side of the business. Give you an example. The profit and loss shows how a business is performing. Now, when we say a business is performing, normally we say, yeah, the sales grow by how much per annum, and then their profit grow by how much. This is how we measure the performance of any business. Now, the balance sheet tells us the condition of a business, whether they are healthy or they are distressed, or they are being managed properly. And we can see a lot of these from the construct of the balance sheet, how much assets they have, how they weigh it against the liabilities, and what are their equity, what are the shareholders getting from the business in terms of ROE, what are they getting from the invested capital, so on and so forth. And this we can get from the balance sheet. On the other hand, the cash flow is actually the heartbeat, the blood flow of the business. Now, you think about it. If you are a businessman, I'm sure a lot of our listeners tonight, all right, are businessmen on his or her own right. You may have may have your own small business, or you're managing a big business, or you are a manager in a business or a family business. Now, let me ask you, what would be your major concern if, say, you own a big business, you own any business today, all right? Let's say you own a restaurant during the pandemic. What would you be worried at? Would you be worried at how much profit or loss you make that year? Or would you be worried about, do I have enough cash in my bank? Do I have enough cash coming into my business against cash that I had to pay? The money that I had to pay, physical money that I had to pay, our utilities, salaries, rental, suppliers, so on and so forth. I would say that the pandemic, right, although it's very devastating, but it really does, I would say, reset the entire business landscape. It exposes a lot of business that are, weak, and it also makes good businesses even stronger after, when the pandemic is over. Yeah. So back to the cash flow statements, there are three different cash flow statements, are not just one. So first of all, we have the cash flow from operating activities, followed by investing activities cash flow, and last but not least, financing. So I'm going to talk about these three in detail now. Not too much detail, but to give you a basic understanding. But before that, I want to highlight here that, please do not please do not assume that cash flow is the only important metric when you analyze business. That is not what I'm trying to say. In fact, cash flow just gives us an angle, the angle of how efficient a business is being run. And I want to highlight here that cash flow is not profit, not profit at all, and profit is not everything as well. Now, a lot of people focus too much on profit. And it is also not right to focus only on cash flow. It has to be a balancing act. Okay. Now, what's cash flow statement? Cash flow statement is a real cash transaction for any sort of inflow and outflow for the following activities. All right. So before we look at the activities, maybe to clarify on the inflow and outflow, right? So imagine you are a business. Cash coming into your business is a positive transaction because cash is coming in. Cash that you pay out of the business, all right, for your expenses is an outflow. So in terms of the mathematical operations, arithmetics is a negative transaction, all right? So whatever is presented here is a net figure of the inflow and the outflow. Okay, give you an example. Under operating activities, right, it is any type of transaction that requires cash which is related to your profit making, or what we call economic activities. I'll give you an example. If you are a business that sells computers, all right, every time you sell a computer, cash is coming in from this sale. So it is a positive transaction from the business. Every time you buy your materials from your suppliers, right, it is things are coming in, but cash is going out from your business. So these are cash outflow related to your operating activities. But you may be asking, are all cash transactions related to the business's economic activities? Not necessarily. For example, back to the example of the computer business. Say suddenly you buy a land, because you have got so much money, right? You don't know where to spend, okay? And you buy a piece of land. And this land is not related to generating your sales of your computers or your other devices that you are selling. And this land is purely for investment purposes. So this cash transaction will not be recorded as an operating activities cash flow, but instead an investing activities cash flow. Okay, so investing activities cash flow can be related to cash transactions that is related to the business. Which related to the investment activities. Now, investment activities can also be related to the operating activities. For example, if you are a manufacturing company, so you manufacturing phones or computers, right? And you need to expand your factory because business is very well, business is very good. In fact, during the pandemic, your business has a boom, so you need more capacity. So you invest in, let's say, the plant next door. You buy a new factory. You convert the factory to your manufacturing plant. So these are the investment that you are partaking to grow your business. All right, and this is normally what we call capex. Capex stands for capital expenditure. All right. So this is also part of investing. So when you spend money to grow your business, to buy, to purchase investments. Sorry, it can also be financial assets. For example, you can also buy stocks. Okay, you can buy bonds. Okay, you can buy any type of financial assets and for investments. Or this is also called investing activities transaction, right? So every time you pay money out of the business for this investment activity, it is a negative because money is going out of a business. But what you say, you have an old plant and you say, oh, it's no more it's not useful anymore. It has reached the end of life. I want to sell it. So you found a buyer, right? And you sell this piece of land, right? So you get money, isn't it? Now let's not talk about the profit first. Let's not talk about the profit that you made from selling this. It's really the cash transaction, right? So whatever money that you received from selling this asset will be considered as inflow of the investment activities. All right, so remember that. So every year there will be several transactions like these, and at the end of the year or at the end of the reporting period, the cash flow from investing activities will be a net of these transactions related to investing activities. Okay, you guys clear so far? Pretty simple, isn't it? Now, last but not least, is also a very important activity of cash flow. It's called financing activities. All right. Now, financing activities cash flow is anything, any cash transactions that is related to how a business seeks its funding sources or how it repay the debts, all right, or even paying dividends or receiving dividends. All these are grouped under financing activities cash flow. For example, back to the business now where you want to buy a piece of land, right, which is not a operating activities cash flow, but it's a capex. All right, which may or may not be related to your core business. So say you want to buy a piece of land, all right, for investment, but you don't want to use, you may not have enough money, so you try to get a loan from the bank, right? So if let's say the bank approves you for 1 million ringgit to buy the land, right? So this is a 1 million ringgit inflow of cash flow of cash, right? But of course, at the same time, you have to pay. Maybe you had to pay by installment or whatever that you have with the vendor, right? So it is the same for other assets or other capital sources as well. Now, sometimes a listed company they can also raise money from their shareholders or from different other sources like bonds. All right. I'm sure you guys have rights issue, isn't it? Sometimes business, because they need to expand, they can actually raise money from the shareholders by offering rights issues. And when the shareholders take up the rights, they pay the company a certain amount of money in order to attain the rights to buy additional shares of the company. Then the company gets the money. All right, gets capital to expand or do whatever working capital expenses. At the same time, they will also offer these rights issues holders an additional number of shares based on whatever that they have subscribed to. All right. So these are all the cash transactions related to financing activities. Now you may be asking, hey David, so cash flow, right? Is positive always better? Is always good? Or does it mean that negative is always bad? Not necessarily. That's the answer. It depends on the context. For example, so whatever that I've talked about in this webinar, right? It is applicable for manufacturing, for most businesses, except for banks, except for insurance, except for financial institution type of business. All right. And at the end of that, right, whatever I'm sharing is actually applicable. Now, let's say you are a trading company or you are a manufacturing company, right? So for the operating activities, what do you think? Is positive always good or negative? Cash flow is good. Think about it. If you're a manufacturing company or a trading company. Now, if that's the case, right, for operating activities, positive is always better because it shows that your business is generating enough cash flow or positive cash flow from the business. Now, don't get me wrong, a business can be profitable, meaning they can record a profit, but at the same time, they have a negative operating activities. All right. So I'm going to talk a little bit about that later. It can happen. All right. But for investing activities, cash flow, whether it's negative or positive, better or otherwise, depends on the context. So you have to look at what makes it so. Now, give you an example. Normally, for investing activities, if it's negative, right, it shows that the company is in a net basis that they're spending more for investment compared to selling their assets. Then you ask me, hey, David, every year this company gets positive investing activities cash flow. Good, right? Because they keep on selling, right? My question to you is, how long or how often do you think they can sell their assets? I'll give you a very good example. The shipping business, as you know, for the longest time, right, they have been in very bad shape because of oversupply of the vessels. It's just that after the COVID, right, suddenly because there are a lack of ships, lack of shipbuilding, lack of cargoes, right, suddenly shipping is booming, right? The shipping rates, the freight rates are actually booming sky high because of lack of these supply, right? So before that, a lot of shipping companies are actually selling their old vessels to generate cash flow to sustain the business. So for many years, you see that a lot of these companies, shipping companies, they're investing in this cash flow will be positive. So then you have to think about, is this really healthy? How long can they sustain? Or how long do you think they need to do this before they can turn around? So you got to ask this question. But in terms of financing activities, personally, I would prefer to see a negative more than a positive net transaction. The reason is very simple. If a company is always reporting positive financing year in, year out, right, it tells you that this company is always raising money, either from borrowing from the bank or raising from the shareholders or raising through other financial instruments. Again, you ask yourself, is it healthy that they are always borrowing money, right? Just like a person, if the person is an individual is always getting more and is getting himself or herself more and more debt every year, right? Something is not right, isn't it? It's the same for a business. So for financing activities, I would like to see a net negative cash flow rather than positive. And the other reason is also when companies pay out cash dividends, it is categorized under financing activities cash flow as well. So later on, I'll show you some examples of how some companies manage this. Yeah. Now, if you sum up all the operating, investing, and financing activities cash flow, that's what you get net cash at the end of the reporting period for a business. So it indicates whether the liquid asset of the business increases or decreases during that financial period. Don't forget, because each of these activities can be positive or negative transaction, right? So you, of course, if this is positive and this is negative, positive a positive number, you add with a negative number, it becomes a minus, isn't it? It becomes a deduction. So whatever you sum up all this here, regardless of their of whether it's net inflow outflow, right? You get the net cash. Okay. Now, as I said, generally positive cash flow indicates that a company's liquid assets, right, are increasing in quantity. So is that good? Yes, generally, because it tells you that the business can settle its financial obligations. It can reinvest to grow the business, and it can even return money or capital to shareholders through dividends or any type of corporate exercise. It can also pay the expenses for its operation, all right, as well as provide some sort of buffer against challenges like the COVID-19, right? Now, on the other hand, negative cash flow indicates the company's liquid assets are decreasing. Now, in terms of net cash, of course, every year there should be at least some sort of excess. All right, that's why we get positive net cash. But sometimes business do report negative net cash. So then it depends on how strong is the balance sheet. But I hope that from here you can see that actually all these three financial statements are interrelated. They are not. You should not analyze them in silo. Actually, you should look at them in a totality, a big picture. Okay, so that's about the different cash flow. Now let's look at what are the examples of operating activities cash flow, investing activities cash flow, and financing activities cash flow. Now, by the way, these short forms is just what we use as spiral thinker, right? So out of this context, you may see CFFO, which stands for cash flow from cash flow for operating activities, cash flow from financing activities, so on and so forth, right? So there are many ways to look at it, but they mean the same. For us, we use operating activities. The activities is a small letter, cash flow. Now, under OSCF, whatever receipts in cash from, again, sales of goods and services is a positive transaction. Collection of prepayments, like prepaid, is also a positive collection. It's a positive transaction. Collection of receivables. So you see, this is very important because sometimes when we book a sale, for example, you suddenly, let's say back to the computer shop now, suddenly a school or a government agency bought, say, 100 iPads from you. So there's a lot of money, right? So sometimes they won't pay you one lump sum. They may say, okay, you send me the goods, you send me your invoice, but give me a period of time for me to settle the debt, to pay you the money. So sometimes it can be 30 days, it can be 3 months, and sometimes it can drag to more than 1 year, as you can see later. Yeah. So you see what happens is when you book the sale, when you deliver your goods, right? In the P&L, it is already booked at the sale, and you have to calculate the profit from this transaction already. But in terms of cash flow, you don't get anything yet. Why? Because you only get the cash or part of the cash 30 days later or 15 days later, depending on your T&Cs, or terms and conditions with your customer. So when the business is collecting money from this receivable, then it is a transaction. It's a positive transaction. So you can see the difference between P&L and cash flow now, isn't it? All right. Now, how about outflow? Every time you spend money to pay for raw materials, every time you spend money to pay the payroll, marketing activities, advertising, paying your CEO salary, interest paid to your banks, your creditors, pay income tax, and any other expenses related directly or indirectly to your economic activities. These are all under operating activities cash flow. Okay, so at the end, it is a net. So definitely in this case, for most businesses under study, we would prefer a positive operating activities cash flow. Okay, now, but don't get too worried if you suddenly see a negative operating activities cash flow. That's why I highlight this to you so that you can go and find out actually what happened. Is it because they cannot sell their raw material? Their goods, or is it because they are stocking up on their inventory? You never know. It could be a good thing, right? Or maybe they cannot collect from the receivables. That may raise a red flag. Okay. Now, next, moving on to the investment activity cash flow. For the inflow, positive transaction is any, sale of fixed asset or long-term assets like your land, your buildings, all right? Sale of financial assets, sale of machines, PP&E, referring to property, plant, and equipment, collection of your loans, the principal portion, proceeds from insurance, yes. If you claim insurance, actually, these are also cash inflow as the investing activities cash flow. Now, cash payments, cash outflow under investing activities, you buy fixed asset, long-term assets, you buy financial assets, you buy machines, you give loans to third parties. All right, these are all cash outflow. So these are negative transactions. Again, net, the IICF, the investing activities cash flow will be all the net cash flow related to your long-term assets, as we call non-current assets. Last but not least, the financing activities cash flow. As I mentioned already, every time you raise money through debt, through equity, through sell treasury shares, especially if a listed company has amassed quite a huge sum of treasury shares, normally they can raise money by selling the treasury shares to a interested party through private placement or selling back to the open market to raise money. They can do that as well. All these are positive transactions. Now, when the company pays the principal of their loans, or they repurchase their own shares from the market, or they distribute some of the earnings through cash dividends, these are all cash outflow under financing activities. And again, if you sum up all these are all financing activities cash flow related to non-current liabilities or owner's equity. All right. Okay. So that is what it is. Now, I want to highlight to you actually for these two. If we sum up operating activities cash flow together with investing activities cash flow, we get what we call free cash flow. Now, sometimes an investing activity cash flow can be negative, so it'll be a negative here. If you take this figure, you add with a negative figure, so it becomes minus, right? Then it becomes a free cash flow. Now, free cash flow to us is also an important metric. Especially if you want to look at how a business has been managed over the long term. Now, ideally, a business should generate free cash flow, more and more free cash flow along the way. Sometimes they may go through a rough patch for a couple of years, it's fine. But if you look at long-term basis, it should at least have a net free cash flow over the long term. Now, if it's a negative free cash, if they are still generating or net, they are still having a negative free cash flow over 10, 15, 20 years, right? It's a very big red flag that something is not right about this company or of this business. But again, I have to reiterate, this type of analysis only works for non-financial or non-insurance type of businesses. Okay, all right. So I hope you have followed me up to now. Okay. Now, if you have any questions, you can ask about it later. All right. So I'm going to dive into the working capital management next, because this is of absolute importance as well. Now, and don't take my word for it again. Okay. This is a statement by Nestle, Nestle SA, not Nestle Malaysia. This is the headquarters in all right. This is based on the July 2018 edition of Nestle's report on alternative performance measures. You see, Nestle do not really look at P&L as well. In fact, the group monitors average working capital to evaluate how efficiency it is at managing its operating cash conversion cycle. So there are two things here I want you to take note of. One is working capital, and secondly is cash conversion cycle. These two are intricately interrelated to each other. So let's talk about what makes up working capital. So I'm going to show you something visually so that it's easier for you to understand. Okay, now these are all the components that makes up the working capital. For example, the inventory that you have in your business or in your warehouse, this forms your working capital as well. Your cash, or your trade receivables, or even payables. All right, these are all your current assets. Now, sometimes raw materials also form part of inventory. It also forms parts of your working capital asset. Now, on the other hand, liabilities, current liabilities. So you notice that these are not long-term. These are all the current assets and liabilities, including what you owe for wages, your rental, your utilities, taxes, trade payables, something you have to pay, right? All these, and among other things, form your current liabilities. Now, if you take current assets, might take away your current liabilities, what you end up is your working capital. Now, working capital again includes cash, inventory, or your raw materials, work in progress, your operating expenses, your trade receivable and payable, short-term debt, so on and so forth. These form your working capital. And working capital is what a business need require in terms of cash or capital for them to run the business operations day in, day out. Okay, that's why working capital management is very important. Then you may, some of you, I mean, logically speaking, right? Working capital, then of course, the bigger the number, the better. Is that true? Not necessarily, because sometimes you have to look at it in its context. For example, sometimes when inventory can be too much, or you can have too much cash on hand, which means that yes, although it's safe, but maybe you're not really sweating your assets to generate profits of the business. Now, don't forget, how we measure the performance of a business is not through the cash flow, but from the P&L. So like it or not, we have to, I mean, any businesses managers have to sweat the assets, especially the current assets here, or the net, right? In order to generate economic activities, to generate sales, to generate profits for the business. At the end of the day, all businesses are created for profits, isn't it? Now, but sometimes a very plunge in working capital may not necessarily be bad as well. So you have to look at things in context. Yeah. Later on, I'll go through some examples. Hopefully, it's easier for you to understand. Okay. But normally, when we read financial statements, especially the annual reports, we focus a lot on how the working capital is being managed in the business. Now, sometimes when the sales boom, right, or the company suddenly business enjoy a lot, have very high sales, right, like your computer shop this year, naturally your working capital also increases. Why? Because you need to have more, you need to buy more inventory, you need to pay more, you need to expand your human resource capital, so on and so forth. So you need more working capital. All right. So not necessarily that sometimes when you see a spike in working capital, it is a red flag. Not necessarily. Okay. All right. So it depends on the nature of the business. Now, next, I want to move on to what I call the CCC, or cash conversion cycle. Now, cash conversion cycle is very important concept as well as metric, because it tells you how long it takes for a business, for example, to convert inventory or raw material to work in progress to finished goods. Okay. Then it also asks questions: how fast can the goods be sold? And how fast or how soon can the sales be translated to cash? And of course, it also tells us how fast or how long do you want to drag the payment to the suppliers or the creditors. Right? Visually, it looks like this. Now, of course, a business, you have to buy raw materials, but don't like any other transactions. When you when a business takes in raw materials, they may not necessarily have to pay on time or on the spot. They can also drag this payment for these raw materials. But once the raw materials are in the warehouse or in the production factory, right, then we can turn it into work in progress and finally to finished goods. Then the marketing team can sell it. All right, now every time the finished goods is being sold, again, just like the raw materials, we may not necessarily receive cash right away. We may receive a portion of it. For example, your down payment, your prepayment, or when you take the deposit or something, right? So you can take a portion first, then the balance you can actually book it as a receivables, which you will receive sometime down the line. All right. Then when everything is being collected as cash, then you use this cash to pay your suppliers, all right, or your creditors. Now, this may not necessarily happen in this linear fashion. Don't get me wrong. This is just a very simple illustration. things can happen anytime along the way. So if I put things in the context, right, I'm not sure if you still remember this. In fact, I showed this these visuals in the April session. So let's look at this. So if you draw a line, all right, a horizontal line to show in terms of timing, right, where all these activities come in, right? For example, where raw materials are purchased, all right, not in cash purchase, it could be purchased in credit. Then this you record this is day one, so then you count the number of days when this inventory are being turned into this inventory or raw material turned into work in progress, turned into finished goods. Okay, so this is the time. Then for finished goods, you have to sell, right? So now, when you sell it, then of course this is when you get your cash. But don't forget, these raw materials, when you purchase it into your business, you may not pay at this point. You may pay somewhere down the line. Say you pay here. So this is when your payment is made, meaning your cash is going out of your company, of your business to buy this raw material. And then you ask, when do I collect the cash from the goods sold, whereby I use these raw materials to produce? And it is here. Imagine you collected your payment here at this point. So the difference between this point and this point is what we call the cash conversion cycle. It is the 2 points. It is the 2 points whereby it recorded the first cash outflow and as well as the cash inflow from that particular sale. All right, this is what we call the cash conversion cycle. Now, bear in mind that different industries will have a different cash conversion cycle. That's why when you analyze this metric or analyze this parameter, it is best to analyze it as an industry. You cannot analyze the CCC of a furniture business against a fast moving consumer good. You cannot analyze a CCC of a semiconductor business against a property business. It doesn't work that way. All right. Some businesses naturally, by nature of how fast the goods are being turned over, all right, they normally enjoy a very short cash conversion cycle. Some companies, for example, properties, you take months, sometimes years to build property or construct property, right? So naturally, your cash conversion cycle will be very long. Okay, so you need to look at things in context. I'll give you an example. This is what we did, an exercise we did way before the pandemic. So we once upon a time before the pandemic, we compared. We're not saying which company is better than the other, but we are using the cash conversion cycle as a yardstick to compare how efficient is the business in generating the cash flow. So we compared 3 glove companies between Top Glove, Hartelaga, and Kosan. So I'm going to give you a couple of seconds to look at these numbers. Focus on the cash conversion cycle here. So for example, Kosan, based on in 2018 or in the past average of the latest 3 years in this record here, they'll take about 100 days or slightly more than 100 days to convert their inventory into cash from the sales. So that's roughly about 3 months. Hartelaga, on the other hand, takes about 78 to 80 days, which is again less than 3 months. This is more than 3 months, this is less than 3 months. On the other hand, Top Glove takes 60 days, which is about 2 months to convert the cash. So in terms of CCC, looks like Top Glove was the most efficient business here. And why is that so? You have to look at things in context. I would say that actually Top Glove is very good at collecting the cash from the sales, which means that they are very efficient to chase the receivables, right? As you can see here, their sales outstandings is actually related to accounts receivable. So Top Glove has a shortest day sales outstanding of 44 days. Hartelaga is almost the same, but the longest is actually Kosan. All right. So this is how we look at things, how we look at the cash flow efficiency in any business of the same industry, through the cash conversion cycle or through the the details like accounts receivable days, inventory days or accounts payable days, right? So these are some of the examples here. Now you can do this for the businesses that you invest in, or when you say you like semiconductor companies, you like OSAT companies, for example, now which is the best, all right, or which you think has the best cash flow management, you can use this method to look at it. Okay, but remember, should not be your only a yardstick or your measurement parameter. It just gives you a view of the business in terms of efficiency. Okay, so I hope that's clear enough. All right, so let's look at time now. It's 9:20, so we've got plenty of time. Now let's move on. I guess next will be the case studies. Okay, great. Now, again, whatever I shared just now is quite theoretical, so maybe a bit boring, but I'm trying to make it more interesting by sharing some of the more timely case studies that is happening around us right now. So for that, I need to look beyond KLSE now. Now, I'm sure you guys have heard about this company or at least read some of the headlines of China Evergrande, right? Now, China Evergrande, for information or for some background, it is the second largest property in China, all right? They are listed both in Shanghai as well as Hong Kong. Now, recently, the company went into a lot of trouble because they cannot fulfill the financial obligations. So where is that in cash flow? Okay, let's look at this. So which means that actually they cannot fulfill this part. Sorry about that. They cannot fulfill this part. Repayment of the debt, principal or even interest here. Repayment of interest is actually under OSCF. So this is repayment of debt. They cannot pay their bondholders. Wow, very bad. All right, when a company is going to default on their bonds, it's actually a very bad sign. I'm sure you guys have seen some videos on social media of how some Chinese uncles and aunties are crying and how they are being stopped by the police, right? And as a result, the share price has tanked more than 80-90% in the past since the peak in 2018. Okay, so let me ask you, did this happen overnight, or can it somehow be preempted from the financial statements? Again, I want to highlight to you the dangers if you only focus on the P&L. Now, if you look at here, hopefully, let me zoom in for you guys. If you look at the P&L only, right, you can see that, since 2004, Chinese Evergrande, this is in renminbi, they grew from 1.4 billion renminbi to 500 billion renminbi in 15 years. Wow. In terms of performance, in this business performance, absolutely, they're growing 500 times. All right. They're growing absolutely huge growth. In terms of profits, do they make profits from 79 million ringgit in 2004 to 31 billion ringgit. Wow. That's a huge jump in profits as well, right? So if you just look at the P&L, you think that, wow, this company is growing. It's a great company, isn't it? But if you look at the cash flow, let's not look at the debt first. Just look at the cash flow. Are these profits backed by real cash transaction from operating activities, which is OSCF here? Look at it. Look at these few years here. Yes, revenue grew every year. Profits grew every year, but look at the cash flow from operating activities. It's red, which means that in terms of the cash flow transaction from operating activities, the company is actually bleeding cash. Why? Because their expenses are more than their sales. All right, you can see here. Now, then you may be asking, hey, how can the business tahan so long? Having a bleeding cash year in, year out for 1, 2, 3, 4, 5, 6, 7, 8 years. Can, by raising money from financing activities. You see, for how many years their financing activities is positive. Then they have been raising money from the borrowing money from the bank, from the shareholders, they even become their own bank to underwrite certain financial products to raise money. All right. Then you may be asking, is this sustainable? 1 year, suddenly 2018 they have positive operating cash flow, 2020 positive, but you have to look at things in totality, look at long term, right? Now, of course, I do not discount that after this, they could turn around. But again, one swallow does not make a spring, right? You have to look at this, see whether they can sustain or they can repeat this performance here. Okay. Now, and as I mentioned, I also mentioned about free cash flow, isn't it? So free cash flow is operating activities, you sum it out with investing. And because both are negative, you can see that actually this company has been bleeding cash for the past many years. Now, if you sum things up, you can see that for the past 15 years, between 2004 to 2020, no, sorry, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 17 years, pardon me. For the past 17 years, this company has bled out 615 billion renminbi, bled out. At the same time, they have also borrowed 774 billion renminbi. Think about it. Just use a logical, you don't even need to be a businessman, right? In the past 17 years, they borrowed in total 774 billion. At the same time, they bled out. So where did all this money go, right? Yeah, you're scratching your head, right? But this is actually a premonition. It's a sign that something is not right in this company. So if you ask me truthfully, if this is this news came as is this news a surprise? Not in fact. We've been talking to some of our fund manager associates in Shanghai, in Hong Kong, right? They say actually, if you are a value investor, right, actually you would have sold off any products or financial products related to Evergrande since 1.5 years ago already. All right, and then before this boom, I mean before all this thing crash, then you may ask, hey David, this is a property company, right? So isn't it normal for a company? Look at their cash conversion cycle. 1,000 days. Now, what is 1,000 days? Have you have a thought about it? Based on the 2000, let's say maybe 2019 is a special year lah. But you look at the average for the past 5 years, it's about 1,900 at best, 871 in 2020. What is the meaning of 800 days or 900 days, right? 1 year, how many days are there? 365. So it means that the cash conversion cycle, so let me remind you what is cash conversion cycle. It's from this point, from this point to this point, this point to this point, it takes 3 years to collect your money, right? So you ask, is this a good business? Well, you say maybe it's typical, typical for a property company. So let's not be so biased. Let's look at another company, also a property, but not listed not in China. They're domiciled in Hong Kong. They are one of the, I think they are the biggest properties real estate company in Hong Kong. All right. You can see here, yeah, they are also growing, but not at the crazy rate like what Evergrande enjoy, right? In that similar period, this is about 16 years. Okay. They are profitable. But let's look at their cash flow from operating activities, especially in the past 1, 2, 3, 4, 5, 6 years. You can see very clearly, right? Actually, this business in the past 1, 2, 3, 4, 5, 6, they are actually very healthy. Why? Because they are generating a positive operating cash flow. Then, of course, you can look at the debt. Yeah. Later on, you can look at the Evergrande debt. It's actually the net debt is much higher than their total equity. Your shareholders' equity. Here, at least for Sun Hung Kai, they are actually very, very strong in terms of the balance sheet. Now, let's come back to the free cash flow. The free cash flow, yes, is quite lumpy, but at least if you look at things in totality, this business is doing very well. Now, if you sum it all together, right, I think you get a positive, we get a number which is much bigger than this. I'm sorry, I forgot to add this, so I don't have the numbers here. Right. And then I want to show you here, which is the stark difference between this Sun Hung Kai as well, Xing Hung Kai as well as this Evergrande, right? in terms of the financing activities cash flow, you can see that for some years, they're actually having a negative financing activities. So what does this mean? It means that they're actually paying, then in net, they are paying out more loans, more debt, at least the principal, than they are borrowing. So this is a good sign for a property company because it shows that they are generating enough cash flow for them to repay their debts, to fulfill the financial obligations. And that's why you can have a positive net cash at the end of the year or financial period. As you can see here, the cash conversion cycle is even longer than China. So what does this mean? It means actually, in comparison, takes much faster to build and sell a property in China compared to Hong Kong. So that's what it means. Okay. Now, then you ask, so I gave you two examples of very poorly managed, in terms of cash flow, a very poorly managed business against a normal or a well-run company. How about Malaysia? But this, how in the context of Malaysia, do we have such companies? I can tell you there are plenty. All right. Now, case in point, there's one company which ran into trouble. It was categorized as PN17 back in 2019. Okay. Now, I'd like to talk about case studies, historical case studies, at least, don't get into trouble because all these are published already. It doesn't mean that I'm trying to smear a company. But of course, that time, this company was actually going through a rough patch internally as well as a business, right? So some shareholders, if you remember, if you have followed or at least invested in this company before, you would have remembered a lot of drama in the AGM where a lot of shareholders suddenly, who amass a lot of shares, they are nominating their own directors to kick out the existing board of directors, so on and so forth. Okay. Now again, things like this can be preempted. Now, for background, Sisera is a tile company. So, tile company, you don't expect the cash conversion cycle to be very short, isn't it? Now, let's look at these are some of their financial figures. If you look at the revenues, is this a growing company? Quite obvious, it's not. In fact, sales are dwindling, right? In the past, in this period. Okay. Are they profitable? They are profitable. Interestingly, they are profitable. Before 2018, I can see they are profitable. And you look at the cash flow, it's very lumpy, all right? Especially some years, it is negative, but let's look at things in context. To me, for example, 2012, 2013, and 2014 are actually very bad years. Why? Because you see, 2012, the revenue is 38 million revenue, but they have a net cash flow from operating activities of 72 million, double of the revenue. By the way, double of the revenue. What's going on? You may be asking, right? Okay, so this is what's happening, right? Then, in terms of their financing, they have been heavily borrowing especially in the last 3 years of 2016, 2018. Why? Because you see, in the free cash flow is very, very negative here. Why? Because their operating activities cash flow is very bad. They cannot generate cash from the sales. And most importantly, they have been borrowing heavily in these 3 years as well. Okay, so imagine if they have failed to secure funding here, the business would have gone under much earlier already. Okay, now then you look at the average cash conversion cycle. This to me is a telltale sign of this company heading into trouble at that time. You see the cash conversion cycle jumped from 3 months to 1 year to 2 years to 3 years in a span of 1, 2, 3, 4, 5 years. This is actually a very big red flag already. If you see numbers like this, right, actually, to me, the top line, the P&L is a bit meaningless already because this shows you either there is a huge change in the business model or they may suddenly switch from a tile company to property development. I don't know, but it didn't happen. So they are still in tiles business. This showed me that actually something is very wrong already. So which means that actually all these numbers here, this cash, this P&L, right? To me, I would study it, we analyze it with a very big pinch of salt. Okay. And that is why it came to no surprise that in 2019, this company went into a lot of trouble, right? So I think they almost become insolvent. I think their debt has, they have amassed too much debt. That I think their creditors are going after them. That's why they went into PN17 status. Okay, now I'm showing this case study to you. It's not to belittle. In fact, I think this company is still around. I think the new management is trying to turn around the business. Okay, it's to show you actually sometimes a lot of things can be hidden. All right, or not. I would say not hidden, but a lot of things cannot be ascertained from the P&L, or even sometimes the balance sheet, or even sometimes the cash flow. So we need to look at the working capital management, and sometimes, and a lot of times, you can derive a lot of clues at looking at how a company manages cash flow running the business. Okay, so hopefully I've shown you enough bad examples already. Okay, now let's look at a good example. And that's why I'll talk about Nestle. Nestle is always a company that I would like to use as case study to show, to underscore how a business should run. Okay, now although it's very boring, share price in terms of absolute figure is very high. All right, but this is an absolutely wonderful company. By the way, disclaimer, I'm a shareholder. I'm a long-term shareholder of Nestle, right? So there you go. Now, in terms of revenue, is this company growing in the past 16 years? In 2004, they booked a sales of 2.9 billion ringgit. In 2020, it's 5.4. Yeah, they are growing. Yeah, it's not high growth. They are actually almost double up in 16 years. So it's not very high growth, but at least they're growing. Are they profitable? Yes, definitely. All right. Their profit also grew almost in tandem with their sales. But let's look at their cash flows. Just take a couple of seconds here. Look at that cash flow. All right. The cash flow from operating activities jumped almost 3 times. All right. From 376 million to 900 million. In fact, in 2018, they peaked at 1 billion. All right. Are they investing every year? Definitely, they're investing very healthily every single year because it's net outflow, negative. Financing, how come every year negative? Yeah, is this a bad sign? Is this a red flag? That's why you have to look at things in context. Okay, now if I sum this up, right, and let's compare this with the Evergrande example. Although there are 2 different industries, right, but I want you to look at how a well-run business manages their cash flow. Now, Nestle is a business that over the past 16 years amassed 8.4 billion free cash flow, where along that same period, they paid out 8.5 billion as well through financing activities. They may be asking, hey, what's going on? Can I say that whatever free cash flow that they generate from their operating activities, net of whatever they need to grow the business through capex, they pay off everything through financing? True. But again, as I mentioned, financing, there are many elements, right? Not just that. There is also something called the distribution of cash dividends. Now, you may be asking, hey, how do I know that most of this money is actually distributed as cash back to the shareholders? You look at the dividends paid, not the absolute figure, but the payout ratio. Look at this. Now, just look at this. Now, I zoom in for you guys to see. What can you tell me about Nestle's history of dividend payout from 2004 all the way to 2020? Okay, especially for the last 10 years, what do you see? Or last 5 years? It is close to 100% or even higher than 100% for some years. What does it mean? It means that whatever profit they make here, net income to the company, they pay out as dividends most of the time. Then you may be asking, hey, something is not right, isn't it? Don't the company need money to retain some profits in the business to grow the business? Yes, they do. In fact, they definitely do, but they do not use their own money to grow. They use other people's money. Why? Look at their working capital management. Look at their cash conversion cycle, especially in this part here. I zoom in for you guys to see. All right. This line highlighted in pink is their cash conversion cycle. something not right. This is negative. How can cash conversion cycle be negative? Is it possible? It is absolutely possible. Let me show you. Going back to this picture again. All right. In Nestle's case, it's Nestle's case, right? Okay, let me just highlight here, zoom in here for you guys to see. When we have a normal case like this, a scenario like this, the cash conversion cycle is a positive number of days. When it is negative, what has got to happen, right? When it is negative, it means that the payment made here from the accounts payable is actually happening after the payment is received from the goods sold. All right. In other words, Nestle has been using other people's money, either the bank's financing or their suppliers' working capital to finance their operations every single year. Yeah, you can see how, of course, you may be saying, hey, this is not a very ethical way of running business, right? Well, it depends on which angle you're looking at. Now, Nestle, although they have a longer payment period for the suppliers, but what they can guarantee is they will always pay out. When the time comes to pay, they will always pay out. And that is much better. If I'm a supplier to my client, I would rather have that surety, that a guarantee that my client will pay me, other than every time I ask for payment, the client will drag me for days and months or even years to come. I would prefer that at least there's a guarantee, at least it's consistent, so that I can plan my own working capital management for my own business. Okay, so that is one way of looking at it. It is a very unique way we look at this. Of course, there are other metrics as well, like because of the efficiency that margins have increased and so forth. There's so many ways to look at this, but tonight I just want to highlight the importance of cash flow. There are, again, just to recap, there are 3 cash flow statements, which are operating activities cash flow, investing activities cash flow, and financing activities cash flow. And the free cash flow is derived by adding the operating activities with the investing activities cash flow. All right. And we also talk about the working capital management, where we highlight what are the components that make up your working capital, as well as the concept of cash conversion cycle. Okay. So with that, I know it's not very sexy compared to the other tech stocks, but it's important that you know this. At least when you analyze your business, your investment that you hold, or even analyzing your own spending habits in real life, right? Actually, this is very important as well. Okay, Shane, I guess this is the end of my presentation. So, and back to you.
All right, thank you so much, David, for doing this session in a very detailed format. I think many of us here have find this very useful. So you have find this very useful, right? Could you give us a 10? You write 10, okay? In this session, you find that this is a 10 session, okay? Wow. I think today a lot of us here have understood cash flow so much better right now, okay?
Thank you.
So if you have any question to ask David, you may write in the Q&A segment where we will pick your questions to us, but due to overwhelming response, we may not be able to address every question. So, but one question that I noticed that many people ask is that, David, where can we find the average cash conversion cycle?
Okay, if you rely on quarterly reports or the annual report from the company that you download from Bursa Malaysia, right? Unfortunately, you have to calculate on your own. But there are actually some databases like Bursa Marketplace. They do publish the cash flow from operating activities plus they do publish these figures like accounts. Some of them, they don't call it DSO or days sales outstanding, they call it accounts receivable days. These are accounts payable days and inventory days, right? All right, so you can actually use this. You use this formula. Again, it's very simple. You take, where is it? Where's the case studies? No, here. All right, now you use this figure, you use this very simple graphic to calculate. Then you can find out the answer already. For me, I subscribe to a few database provider. For international market, I focus on two. One is Guru Focus, as well as tikr.com. You can go and look at it. Of course, if you think that you're not ready to pay for this subscription, right, you can refer to your broker or to Bursa Marketplace. I'm sure you can find some the data there, but just that you may have to do some post-processing. You may have to do your own calculation. Okay, Shane?
Okay.
Oh, you mean in the financial statement, where does it appear? Is it? It appears in the balance sheet. All this, you have to convert it. There is a formula to convert the figure to days inventory and days receivable. There is a figure. So tonight, because I don't want to dive into the mathematics, I just want to look at the application. If we dive into mathematics, I think a lot of people will get bored.
So Vivian asked how to calculate average conversion cycle if you didn't subscribe.
Okay, it's very simple. From here. Now, the cash conversion cycle is the difference between your days receivable here plus your days inventory minus your days payable. Okay, so again, days inventory plus your days receivable, take away minus your days payable. Okay, now how you calculate the days payable, days inventory, and days receivable, right? I think days inventory is you take your inventory, total inventory divided by the sales, multiplied by 365. Days receivable is you take your accounts receivable divided by sales, multiplied by 365. I think days payable is you take your accounts payable divided by something else already and multiply by 365. I can't remember the formula now. Right? As I think it's very obvious to you, right? I don't calculate. Actually, I just refer to the data that I subscribe to. It's easier to tell the truth. I don't really have time to calculate. Yeah, I rather pay some money for somebody to generate the figures, and then I'll just analyze it. I'm sure you just Google. It's very easy to find. Just Google days payable formula or cash conversion cycle formula. There are a lot of resources out there.
Okay, so the next question is asked by Ang Beng Kwan. How do you differentiate between operating cash flows and funds from operating activities?
I don't quite get the answer. What is the meaning of funds from operating activities?
Maybe Beng Kwan, you clarify for a bit, then we take the question after that. After clarifies, okay? So Fahuruzi would like to ask, which one is more important? Is it net cash from operating activities or operating cash flow before working capital changes?
Okay. Normally, when I read the financial statements, I read it from top to the bottom. So in context to your question, I will first look at the net cash before working capital changes, because I want to see whether sometimes is there a huge depreciation charge or is there any unusual items. Then I will look at the working capital changes. Then I will need to see, is the changes in working capital in tandem with the growth or the P&L? Now, let me give you an example. As I mentioned earlier on, if there is a spike in working capital, all right, so what is working capital again? Just referring to this. These are some of the examples of working capital. If there's a spike in working capital, then I will go and look back at their P&L. Has the P&L grow as well? Has the sales grow? And in fact, not just like that, I want to look at the magnitude of the growth. Let me give you an example. If the sales grow by 100 million and the receivables grow by, say, 50 million or 60 million or even 100 million, I'll say, okay, it's quite normal. All right. But of course, I will need to look at the next reporting period. I want to see how fast the business can collect the cash. But I give you an example. If the business booked a sales growth, additional sales 100 million, but the receivables went up by 200 million. Oh. Of course, I'm just being a bit extreme. That to me is a red flag. Okay, so I analyze it like this in this way, so that I look at this in context, right? And then at the end of the day, it is the net cash that is from these three financial statements. They will tell me how it will affect the balance sheet at the end of the day. So to answer your questions, and first I look at the net cash before working capital changes. Then I look at the working capital changes and what causes the changes, or is it, and then I analyze it in with reference to the P&L. Then I look at the net cash from operating activities. Sometimes, maybe I can explain a little bit more. Let me give you an example of, I'm sure you guys know Padini, right? Right? Now, Padini, a lot of people think that Padini manufactures their own products, their own shirts, their own apparel. Actually, they don't. Their inventory consists of raw materials. They buy the raw material, they buy the cotton, they buy the yarn. Then they don't manufacture it. They actually they actually outsource the manufacturing in China. All right, they get somebody to make the clothes for them. Then they ship it from the supplier for the contractor and sell it. Okay. Now 1 year, because Padini is a cash business, and they cater to the mass market. So naturally, you expect this company to have very strong cash flow management, right? Especially operating activities cash flow positive. Now 1 year, suddenly there was a dive in operating activities cash flow. Okay. Chun Sen, can I use TIKR to maybe answer this question? Can I?
All right. Go ahead.
Go ahead. So where is it? Are you still seeing my screen?
Yes, we are still seeing your screen.
So you see this TIKR terminal, right?
No, we are seeing your slide.
Oh, sorry about that. So let me unshare. Let me share this screen. Okay, so this is the one of the financial data that I use. All right, so I type Padini Holdings. Okay. Now, why I say this? Why I bring it up to show you sometimes you have to look at things in context, not just analyzing the numbers. Okay, as you can see here in terms of cash flow, right? Look at maybe I drag a little bit more. I don't know when it happened already. Okay, maybe I do here. All right, and then I do free cash flow. Yeah, don't have free cash flow here. Okay, never mind. Let's look at investing activities. All right, let's see. Okay, here. Now, look at, I'm not sure if it was this year, but if you look at 2014, right, you can see that there is suddenly the cash flow from operating activities, which is denoted in blue color, it just tanked, it dropped a lot. And at the same time, the cash flow from investing activities increased a lot. So here, what happened was, naturally, traditionally, it will generate positive cash flow, but for this year, it was a negative free cash flow. So as an investor, it actually alerted us, is this a possible red flag? Then we go and dive into the accounts. Then we found out, actually it's not. Why? It's because they bought a lot of raw material at that year, because the management anticipate that the price of cotton is going to skyrocket, probably due to weather conditions or some supply issue, that they took the preemptive measure to buy more inventory. Now, you see what happened is, when you use a lot of cash, because it basically it's just converting cash into inventory, right? You increase your working capital, then your operating activities cash flow came down. Then you ask, okay, is whatever doing, is it detrimental to business, or is the management taking preemptive step to secure the raw materials before the price goes up, so that next year they can be profitable again? Right. So of course, after that, we found actually it makes business sense. That's why to us, that particular year, we just consider it as a fluke. Now, of course, as you can see here, after that, it normalizes, and in fact, the cash flow went back on the normal trajectory here. So there is one particular instance whereby we need to analyze things in context, not that every time you see a operating cash flow becoming negative or reducing in drastically it is a confirm a red flag, not necessarily. So I hope I answered the question in as well as giving by giving this example, Chun Xian.
Yeah, actually, Beng Kwan also clarified that funds from operating activities is before working capital changes.
Okay.
Yeah, so which some equity analysts use it rather than net operating cash flow.
Okay. Yeah. Again, I think it was the same question that I answered before, right?
Yes.
Yeah, so you have to look at things. You have to analyze it step from the top to the bottom, right? Because cash flow, how you get cash flow from operating activities, you need to get it from the net income first, or the earnings, or the net profit. Then you take away all the adjustments of the non-cash items. Then you add in the working capital changes. Then you get the net operating cash flow. Now, of course, this is a bit technical. That is not my intention tonight to go through the work of mathematics. In fact, I would rather analyze the application of the cash flow. Yeah.
Okay. This question is a bit more deep and technical. I'm not sure if you're familiar with the indicators or not. Could you explain the difference between free cash flow to firm and free cash flow to equity?
Wow.
Which do you find more important?
Free cash flow to firm and free cash flow to equity. This is by Leon Jack. Wow, sorry, I'm not I don't really analyze this. I used to look at this, especially the owner's earnings. In fact, I even read the book by Robert something on this subject 2 times. I still really cannot gauge the concept. But never mind. I know Leon. It's a question by Leon Jake Lim, right?
Yeah, that's right.
Let me get back to Leon personally, because I'm very sorry. I have to apologize. I do not know how to answer this question tonight.
Yeah, I also find this a bit technical.
Never mind. Hold on. Let me copy first. Okay, thanks. All right.
Okay, done?
Yeah, done.
All right. So next question is by Tiong Hua. For banking and insurance, what would be the key measures, since we cannot refer to cash flow and CCC?
Wow, that's to
answer the question.
Question. To answer that question, you may take a few. It may take a cost. All right, for banking, and there are other financial metrics to look at. One of them will be the net margin. All right. The other one, I forgot what is it again. Obviously, I'm not invested in banks. All right. What's the ratio again?
NIM, net interest margin.
Net interest margin. Yes, thank you. And the other one would be the there's a term, the non-performing loans. Yes.
Gross impaired.
Yes, impairments. Those who normally for banks, I guess you're asking in terms of the red flag, right? So those will be the things that I look at in terms of for banks. For insurance, wow, that is another topic. There are so many other metric on insurance, conversion, these are management expense ratio, so on and so forth, which may not necessarily be you're not able to derive directly from the cash flow statement. Yeah. So to be honest, I personally do not invest in banks, not because they are not good, but because I really don't know how to analyze it. All right, that's one. For insurance, I only invest in one insurance company, and that is Tune Protect. By the way, this is not a stock pick, right? And the reason why I invested in Tune Protect since early days is because I invest in Tune Protect not just for the insurance business, but as a proxy to AHS growth. Yeah. So I don't really look at the numbers in such a detail. Yeah.
Yeah. Actually, insurance is really tough. The balance sheet is very tough.
Very tough. In fact, I give you a very funny thing. Many years ago, I know a banker because he used to attend the same investing course as I did. I forgot his name, by the way. But anyway, I asked him, because he is a VP, quite high. I forgot what was his expertise right then, but it's related to commercial banking. Lah. I asked him, hey, since you're in the bank for many years, right? Do we invest in banking stocks? You know what was his answer? No way. He said, because it's too complex to analyze the balance sheet as well as the cash flow. That's why he didn't invest in it. Yeah. But don't get me wrong, it doesn't mean that banking stocks are absolutely no for investment. In fact, banking stocks are a crucial component of the KLCI. So if you have the skills as well as the background and knowledge to analyze it, by all means, maybe you can teach me. Thank you.
Yeah. For banking stock, the operation cash flow is also vastly different.
Yes, it's very different. No, negative is actually a good sign. Yeah, because banks make money from lending money. Yeah. Okay.
Okay. So let's pick one last question. Let me see. So David, if the company cash flow is positive, sorry, let me rephrase. So if the company profit is increasing, but cash flow is negative occasionally, would you invest in this, or would you hold this company?
Sorry, can you repeat that? If the operating cash flow is positive?
No, let's say if the profit is increasing, profit is increasing, but operating cash flow is not doing so nice. Okay, sometimes positive, sometimes negative, right? So how would you?
It's lumpy.
Yeah.
Would I invest in it?
Yeah. What would be appropriate action? Would you hold or would you?
I think this participant is referring to one particular business, right? Well,
oil and gas company, is it?
I mentioned, please don't analyze cash flow in silo. Now, cash flow can be lumpy, especially cash flow for operating activities. And absolutely free cash flow is always very lumpy one. You cannot, of course, there are some companies that will have very strong cash flow record. And these are exemplary companies. Case in point, the glove makers have all this, I mean, despite the negative sentiment from this post-COVID thing, right, crash, right? Actually, as a business, most of the glove companies, especially the big three or big four, they are actually very well run. Their cash flow management is very solid. All right. Semiconductor companies are very solid as well, especially the big boys like MPI, Unisem, Inari, all these names that I always quote in my sessions. But not all businesses are like that, and it is just part and parcel of running business, especially if you are manufacturing or you are trading. If your business is trading in nature, right? Sometimes, which means that your business is very susceptible to the business cycle, right? Sometimes you get very lumpy cash flow. Again, you have to look at things in context. I cannot stress enough that you have to analyze the financial statement as a whole. Don't just look at cash flow statements as a statement on its own. You have to read the three statements as one single statement. Okay, you have to read it because all of these are interrelated to each other. Now, I'm not the right person to talk about this. In fact, I have a team member who has a finance background, accounting background, and he teaches this in one of our basic courses called FSACC, Financial Statement Analysis Crash Course. All right. For me, I would rather use it to apply to see whether there are any red flags that I need to be careful about. Now, don't forget, cash flow is a heartbeat, but it does not measure the performance. Normally, stock price goes up and down because of how well or how poorly the business performs, not from the cash flow. I would like to stress this. The stock price or the stock valuation is more sensitive to the performance of the P&L, but not the cash flow. But if you want to analyze truly how well the business is run, deep dive, right? We have to look at the cash flow in context to the P&L. Yeah. So just now I talked about Padini. So I hope that the person who asked this question, please look into the details of the operating activities cash flow. What made it negative when it is, in a down year, or in fact, even on positive year, what made it positive? Is it because of the working capital changes, or is it because really the company is growing? Yeah.
Okay, I think since we still have many people here online, let's do one last question,
No problem.
as a bonus. Okay, thank you, David. So from a point of view, do you think that a company with cash rich, zero debt, good to invest in the long term in terms of business expansion?
This question is actually very tricky because many years ago, when I'm a 100% quantitative investor, meaning I analyze the numbers, like really deep dive into numbers, right? I forget about the business, I don't care about the business. I don't care about the business model. I don't care the qualitative. I just look at the numbers. Then I found out that actually some businesses, they look great in these numbers, but they have no growth. Business is in a red sea. So in the end, it became a value trap, which means what? Yes, you invest in a company with net cash, right? No debt, profitable, but no growth. Again, that's why I say you have to look at things in context, right? So what may happen is that, you buy thinking that you have bought into a damn value business, a great stock, right? But you may end up holding the stock or the business for a long period of time that you get fed up. Say, I should have used this money to invest in other companies, right? So that's why I say you have to look at things in context. Don't just look at cash flow. Don't use cash flow as your only yardstick. You have to study the cash flow in context with the P&L as well as the balance sheet in terms for their financial health, right? So to answer that participants' questions, I will look at the growth as well. Now, let's assume that this business is net cash, no debt, profit and loss is actually growing healthily. All right, then I would maybe suggest to the participant to look at what type of business this is. Is it a business that is in high demand? Is it a high growth sector? As well as look at the management. Now, if all these tick, right, and to me, why not, right? It's actually, when it all ticks, it means that actually you found a good company. Now, I would love to find a company at a fair price, meaning I'll invest it, but I would love it even more if the market gives me a discount. Meaning, for example, whatever happens, could be US raising interest rates, could be there's a inflationary fears, so on and so forth. Federal Reserve, tapering down. All this will create a lot of havoc in the market, right? And if the share price or the valuation does come down, then you say, hey, I've done my analysis. This is a great company. They have great cash flow management. The balance sheet is very strong, good management, good business. I will invest. Yes. Yeah. So that is how we look at things, how we connect the dots.
All right. Thank you so much, David, for doing this cash flow session. So
I hope that I apologize if I cannot answer all the questions. As you know, I'm an engineer background. This is not my forte, but I hope to give you at least from the layman's point of view, for a non-financial investor, that at least you can look at things in this manner. Yeah, Shane, thank you.
All right. So thank you so much, David. Let me tell you more about our next session. Yeah.
Okay.
So thank you, David. Okay, for our next session, the topic is on using Elliott wave, identifying price movement patterns in trading. So this session will take place on next Wednesday, that is the 13th of October 2021, 8:30 to 10 p.m. So I've just given you the registration link in the chat box, so you may go there and register yourself if you want to learn about this technical theory and indicator, which is Elliott wave theory. Okay, how to use Elliott wave theory to spot trading opportunities. So that's happening on 13th of October, next Wednesday. So all all in all, we want to express our gratitude to David for doing this very in-depth analysis into understanding cash flow statement. So I think now we all learn why cash flow statement is a heartbeat of every business. So thank you, David.
Thank you for having me. Thank you very much.
Yeah, and thank you every one of you who joined this session. So if you want to catch David have another session happening another upcoming Wednesday. So remember to watch our upcoming emails. All right, so where you can register for David's session. So see you all next Wednesday. Bye. Have a pleasant weekend.